How big of a deal is these big bank earnings season going to be for the overall markets?
Say a lot for confidence. I think it's going to say a lot for a group that has been battered, as you said, and has suffered on the earnings front because we had a brand new accounting treatment, CECL, take place right in the middle of this storm. And CECL requires you to recognize a loss the day you book the loan, your expected loss. So much bigger reserves than under the old accounting treatment. And so it was massive. In the first and second quarters of this year, the big banks have set aside over $50 billion. And I think they're pretty close to having set aside enough even for CECL. And quite frankly, CECL will also allow them to release reserves when expectations get much better. And certainly with the GDP growth we've had this quarter and unemployment falling dramatically this quarter, we'll see some much better results out of the banks than last quarter.
Yeah, I'd like to focus on that a little bit because we make a very big deal about the fact that when these kind of loan loss provisions are taken, they're kind of they're a hit to earnings when they take them. But if they don't materialize, they go right back into earnings. So there should be a bit of a tailwind here. We know the economy is better now than it was 3 or 5 months ago. Can we expect these bank earnings reports to really reflect that because those loan loss provisions are better than we thought?
Yeah, I mean, I think that if you, I've talked to some banks that could potentially release reserves. No one's going to because there's still so much uncertainty. But they also do have a qualitative override, and they'll use that qualitative override to keep the reserves in place. And so I don't think you'll see reserve releases until next year. But that's how strong the balance sheets are. Everybody, you know, when the sell-off happened here, talked about how much that banks' balance sheets were in good shape, way too much capital, way more than the last crisis. The Fed has not let the big banks buy back stock, so capital is built. And they've built these monstrous reserves. So yes, there's a lot of dry powder for earnings into next year. There's a lot of dry powder for growth and buybacks. And so all we need is the U.S. economy to start demand for new loans, because that's the one thing that's not going to be evident in these releases. There's not a lot of loan growth in the big banks.
All right, so not a lot of loan growth, but strong balance sheets. What does that mean for bank dividends? How safe are they, generally speaking?
Well, I mean, the Fed's got a new methodology on the big banks in particular. Most of the big bank dividends are quite safe. I think there's a couple that have cut. I don't think many more are on the edge here. And really, it's because of these non-cash CECL charges that you've got these issues. If you didn't have the CECL charges, obviously everything would be great. And you're treating all of these banks the same. So no one's getting signaled out. So some of the banks have tremendous balance sheets and have much greater ability to pay dividends, raise dividends, buy back stock. They're not going to let them. So you saw Morgan Stanley do something strategic the other day where they went out and spent $7 billion and bought an asset manager. That deal is going to be allowed. Buying back its own stock is not.
All right. So with all of that in context, the M&A, the dividends, the CECL, the everything else, where exactly are you placing your bets? Is it the money centers? Is it the regionals? What outperforms in the coming 6 to 12 months?
Sure. So several factors here. I think the regionals will outperform, particularly the smaller ones, because M&A has to happen, right? You've got a low growth environment. You've got technology winning the day, which means that you've got to consolidate and spend money on improving your systems. And at the end of the day, you've got to be able to compete. And there's so many non-bank competitors, nipping at their heels. And obviously, we've talked a lot about interest rates, the spreads. And yes, the yield curve is widening, but it's still not great in a zero interest rate environment. So the only way to grow earnings is really to consolidate and cut costs and improve technology. And I think a lot of that's going to happen in the coming months. And there is no group out there, save energy, that's going to have much better earnings growth into next year than the banks. So you're going to have a lot bigger growth. You're going to have consolidation. Credit quality is going to be much better. So, yeah, I think that the regionals are a good place to be.
Shepard Smith here. Thanks for watching CNBC on YouTube.